yourselves in the chat as we get started. Welcome and good morning to you all. Thank you so much for joining us. My name is Veronica Soto. I go by Vero, and I am the director of the State and Local Fiscal Recovery Funds Program. On this slide, you can see our agenda for today's conversation. And our conversation is focused on explaining the information in the new section of the SLFRF Frequently Asked Questions, Section 17, Obligations. The link to that FAQ, or the list of FAQs, is located in the chat. As you continue to introduce yourselves, you'll see information in the chat. After many of you finish introducing yourselves via the chat, we will turn the chat off probably around the time I stop speaking, so that if you have questions, you can use the Q&A function for that. So the information we're going to cover today is applicable to all SLFRF recipients, including annual reporters who receive 10 million or less in SLFRF funds. As a reminder, all SLFRF funds must be obligated by December 31st, 2024. Recipients will be required to return to Treasury any SLFRF funds if they have not been obligated by that deadline. So in response to recipient questions about the definition of obligation and many requests for clarifications about how to meet the December 31st, 2024 obligation deadline, in November of 2023, Treasury issued an interim final rule. We call it the obligation IFR, to amend the definition of obligation and to provide additional clarifications for the state and local fiscal recovery funds program established under the American Rescue Plan Act of 2021. Treasury received over 100 comment letters on the obligation IFR. Some of the primary themes in the public comments were around payroll for directly provided services and activities, appropriation and interagency agreements defined as an obligation, and more flexibilities for contract cost increase. Treasury released the new Section 17 of the FAQs to provide additional clarifications on the definition of obligation to help recipients ensure effective and efficient implementation of SLFRF funds. Among other items, these FAQs contain three important clarifications. First, Treasury considers an interagency agreement to constitute an obligation for purposes of the SLFRF rule if the agreement satisfies certain conditions. Second, Treasury considers a recipient to have incurred an obligation with respect to personnel costs for an employee through December 31st, 2026, to the extent the employee is serving in a position that was established and filled prior to December 31st, 2024. Third, Treasury is clarifying how recipients may cover cost increases associated with contracts or subawards entered into by December 31st, 2024. In addition, Treasury has also extended the deadline for recipients to report that estimate of costs to meet certain legal and administrative requirements. This deadline was originally referenced in the obligation IFR and the accompanying webinars that we hosted about it last November. The new deadline is as follows. If you report quarterly, then the report due July 31st, 2024 will be your first opportunity to report these estimates to Treasury. If you report annually, then you will report these numbers in the report due April 30th, 2025. We also clarified that this estimate is not mandatory, but later in the presentation, we'll talk through the circumstances in which you may want to submit some such estimates. So these FAQs are the most up-to-date source of explanatory information about the SLFRF obligation requirements, and Treasury is not issuing a final rule for the obligation IFR. These FAQs clarify the guidance in the obligation IFR and are what you should refer to in order to understand how to meet the obligation deadline of December 31st, 2024. Again, there will not be a separate new final rule. To the extent the FAQs differ from previous explanations of the obligation requirement, either in the preamble of the obligation IFR or in recipient webinars, you should rely on the FAQs. Finally, there have been no changes to either the obligation deadline or the expenditure deadlines. So we'll move on to the next slide. So this particular slide should look familiar to those of you who have joined or watched previous webinars, because it's the same slide we have used in the past. The reason it's the same is because the obligation and expenditure deadlines remain the same. For all 7 eligible uses, including the provision of government services for funds claimed under revenue laws, recipients must obligate SLFRF funds by December 31st, 2024. Recipients must expend SLFRF funds obligated for all eligible uses, except surface transportation projects and Title I projects, by December 31st, 2026. Recipients must expend SLFRF funds obligated for surface transportation projects and Title I projects by September 30th of 2026. With that table setting, we will now move into a discussion of the new FAQs. As a reminder, these FAQs are in section 17 of the SLFRF FAQs. And again, the link has been dropped in the chat. And one more piece of context to keep in mind as we move through today's presentation. This presentation is intended to provide an overview of the content of the new FAQs and explain in plain language what the new FAQs say. We know there are going to be many questions about how you report, especially these new things in the items listed as obligated, given these new FAQs. So we do plan to provide additional guidance and information ahead of the July reporting deadline for quarterly reporters that provides a more practical how-to explanation of how to report obligations. But this presentation will not get into that today. Today's presentation is intended to explain the content of the new FAQs. And with that final piece of background from me, I'm going to turn it over to my colleague, James Bond, to provide an overview of the definition of obligation. James?
Thanks, Vero. Now we're going to walk you through what can constitute an obligation. Some of these items have always constituted an obligation, such as a contract or subaward. And some of these items have recently been clarified as counting as an obligation in the obligation IFR and the new FAQs. So an obligation continues to mean an order placed for property and services and entry into contracts, subawards, and similar transactions that require payment. This definition has not changed since the program launched in 2021. In addition, the obligation IFR clarified that an obligation also means a requirement under federal law or regulation or a provision of the SLFRF award terms and conditions to which the recipient becomes subject as a result of receiving or expending SLFRF funds. Or more simply put, when recipients incur costs related to certain legal and administrative requirements of the SLFRF award funds. This was the focus of our obligation IFR webinar in November. Now, we've clarified in these new FAQs that similar transactions that require a payment include interagency agreements if they meet the conditions laid out in FAQ 17.6. It can also include payroll expenses for recipient employees if they meet the conditions laid out in FAQ 17.7. The key takeaway here is that there are several pathways via which an obligation can be incurred. They are an order placed for property or services, a contract, a subaward, similar transactions that require payment, which may include interagency agreements if they meet the conditions in FAQ 17.6, payroll expenses for recipient employees if they meet the conditions in FAQ 17.7, and costs related to certain legal and administrative requirements of the SLFRF award funds. Now let's talk about what does not constitute an obligation. So an obligation is not an adopted budget or budget amendment, an appropriation of SLFRF funds, an executive order, a resolution, written or oral intention to enter into a contract, a grant of legal authority to enter into a contract, claiming funds under the revenue loss category, and that includes recipients utilizing the $10 million standard allowance. Any recipient using the revenue loss eligible use category must meet the obligation deadline and enter expenditure information as projects in their project and expenditure reporting. And finally, moving SLFRF funds to a general fund as revenue loss, but not further establishing an obligation with those funds by December 31st, 2024. We will explain the last two bullet points about obligating revenue loss funds in a little bit more detail in a few slides, but for now, let's turn to an example that will help illustrate what is or is not an obligation. So the example is a city council has passed its FY24 budget, which outlines exactly how the SLFRF funds are to be used. The question at hand is, has the city obligated its SLFRF funds? And the answer is no. A budget and or appropriation authority for SLFRF funds is not considered an obligation. The city will need to obligate its funds through at least one of the mechanisms outlined on slide 8 and also below, and report the projects in their project and expenditure report that's due on January 31st, 2025 for quarterly reporters, or April 30th, 2025 for annual reporters. Now we're going to open a brief question on the example that we just went through. So the poll should open up in just a minute. Okay, the poll should be open now, and you'll have 1 minute to respond. So the question is, a city council has passed its FY 2024 budget, which outlines exactly how SLFRF funds are to be used. Has the city obligated its SLFRF funds? And you're to choose the best answer. The options for your answer should be on the screen in front of you. So I'll give about 20 more seconds to provide your responses. I see that the answers are coming in. Okay, we're going to end the poll. So thanks for providing your responses. The correct answer is B, no, a budget and or appropriation authority for SLFRF funds is not considered an obligation. So it looks like about 84% of you chose the correct answer. And again, the correct answer for the question at hand, which is a city council has passed the 2024 budget, which outlines exactly how the SLFRF funds are to be used. Has the city obligated its SLFRF funds, the correct answer again is no, a budget and or appropriation authority for SLFRF funds is not considered an obligation. So moving on, this slide is another one that will look familiar to you for those who've joined us in November for our webinar on the obligation IFR. The slide is repeating exactly what we explained then. The obligation deadline applies only to the recipient of SLFRF funds, which is you. It does not apply to your subrecipients. If you've entered into a subaward with a subrecipient, then you've obligated those funds and they do not need to take additional action to meet the obligation deadline. One very important clarification that we want to make, because we've received a lot of questions about this in response to the obligation IFR, is that all SLFRF funds, including those reported under the revenue loss category, must be obligated by the obligation deadline. Please see FAQ 17.15 for this explanation. So this means that projects entered as EC 6.1 projects must meet the same standards of obligation as any other eligible use category of SLFRF. That is, those funds must be obligated via a contract or an interagency agreement or one of the other methods outlined on slide 8. In addition, I want to draw your attention to the last bullet point, which explains how a recipient utilizing revenue loss to pay for government services should report the use as projects under expenditures category 6.1. So recipients must enter a project description for any project entered under 6.1. Revenue loss project descriptions must summarize the project in sufficient detail to provide an understanding of the major activities that will occur. Description should establish what the project seeks to accomplish and should include enough information to make clear how the recipient determined the project's eligibility. So to underscore all the main takeaway from this slide, all SLFRF funds must be obligated by the obligation deadline, using the definition discussed earlier, including revenue loss funds. Just reporting to Treasury that you have claimed revenue loss funds does not mean that they are automatically obligated. Now I'm going to turn it over to my colleague Joel, who will walk through a couple of the new clarifications in the FAQs about ways to obligate funds. Joel?
Thanks, James. Now we want to talk about how recipients can use SLFRF funds to pay personnel who are direct employees of the recipient state, county, city or town, territory, or tribe. Treasury has clarified flexibilities that will enable recipients to keep paying those direct employees until the expenditure deadline. In our new FAQs, we've clarified when a recipient is considered to have incurred an obligation to use SLFRF funds to cover personnel costs for an employee through December 31, 2026. The employee must be serving in a position that was established and filled prior to December 31, 2024. As with all other expenses, the personnel costs must be expended in connection with an eligible use of SLFRF funds. The key thing to remember here is that the obligation relates to the position, not the individual person. We understand that staffing changes occur. As long as the position was created by the end of 2024 and someone was serving in that position by the end of 2024, a recipient may continue to use funds to cover costs for employees serving in that position through 2026. Eligible expenses include all salaries and wages, covered benefits, and payroll taxes. As I just noted, this provision for payroll expenses relates to the position, not an individual employee. A recipient may replace an employee in that position if the position was established and filled by December 31, 2024, and the replacement does not need to be immediate. Recipients may also reorganize positions within the scope of an eligible SLFRF project after December 31, 2024. For example, If an eligible project employs 10 job training specialists on December 31, 2024, it is permissible for the recipient to use funds to cover payroll for one of those training specialists who's promoted to be a supervisor, so long as there are no more than 10 positions covered through SLFRF funds in total. While this provision allows recipients to continue paying personnel costs for existing positions, recipients should note that they may not use SLFRF funds to cover expenses for any new positions created after the obligation deadline. Now let's look at how this might work in practice. Suppose a recipient submits a report to Treasury estimating $100,000 in payroll costs in 2025 and 2026. The estimate ensures that those funds are treated as obligated and can be used for the intended purpose. We will discuss estimates in more detail in a moment. But in this scenario, in 2025, due to a new collective bargaining agreement, staff costs for the recipient have unexpectedly increased. The recipient would like to consider an additional $50,000 in SLFRF funds obligated for payroll costs. The question is whether the recipient can increase its estimated payroll obligation to the amount needed to pay those employees. And the answer is yes. Eligible personnel costs are considered obligated, and that amount may be adjusted based on compensation at the time of the payment to the employees, not those costs at the time of the estimate. A recipient may raise the salaries of the employees in positions created and filled by December 31, 2024. However, they may not create new positions after that date. We'll update the compliance and reporting guidance with additional information about how to report the estimate for those funds and how to report how those funds are ultimately expended. Now we'll look at the reverse scenario. Suppose a recipient submits a report to Treasury estimating $5 million in SLFRF payroll costs in 2025 and 2026. However, due to the completion of a project ahead of schedule, only $4 million is needed for payroll expenses in those years. What can the recipient do with the unexpected $1 million from the estimate? Now we're going to have another brief poll question on payroll. The poll should open up in just a moment, and you'll have 1 minute to respond. The question is, can the recipient use the unexpected $1 million attributable to the estimate for another project? Choose the best answer. And the choices for your responses are A, no, B, if that project meets the requirements of SLFRF, C, the recipient must immediately return the unexpected $1 million to Treasury, or D, unexpected funds can only be used for payroll expenses. Take a moment to answer the poll. Great. Thank you to those who provided responses. The correct answer is B. Yes, if that project meets the requirements of SLFRF. It looks like 86% of you chose the correct answer. Remember that the recipient must have incurred an obligation for the replacement project by December 31, 2024. We just talked a bit about estimates in the context of payroll expenses in 2025 and 2026. Now I want to explain a bit more about estimates in general, what they do, and why a recipient might want to submit one or more estimates. There are 3 separate kinds of estimates of future expenses in the SLFRF program. First, as we've discussed, recipients can submit estimates for payroll costs to be expended in 2025 and 2026. Second, recipients can submit estimates for certain administrative and legal expenses. Third, recipients can submit estimates for potential costs to cover contract change orders and contingencies where a contract provides for change orders and contingencies. I want to emphasize here that these estimates are not mandatory. The reason a recipient would submit these estimates to Treasury is to ensure that the recipient can retain and expend funds they've already obligated for an eligible use. and do not have to return those funds to Treasury as unobligated. This is only relevant in cases where a recipient hasn't reported those expenses through another project in the reporting portal. Because there hasn't been another report, we at Treasury would not be aware that those funds have already been obligated. Submitting the estimate thus ensures that the recipient will be able to spend SLFRF funds on the relevant expenses in 2025 and 2026. So to sum up, the estimate itself is not an obligation. An estimate is one way to communicate to Treasury that funds are considered obligated for a particular purpose. We've already discussed the payroll expenses for which a recipient might want to submit an estimate. I now want to briefly touch on the administrative and legal expenses for which it might make sense to submit an estimate. And I'll note that this provision is not new. The obligation IFR clarified that these administrative and legal expenses are considered obligations. We discussed this in case study number 1 in our webinar on the obligation IFR back in November. I'm just reiterating the flexibilities we discussed in November. So there are some costs for which SLFRF funds are already considered obligated because they relate to requirements of federal laws and regulations and program award terms and conditions. The recipient became subject to those requirements as a result of receiving SLFRF funds, and thus has an obligation to spend funds to meet them. These expenses are listed on the slide, and they're detailed in FAQ 17.10. If these costs are not reported as obligated through another project, recipients can submit to Treasury an estimate of those anticipated costs to ensure that the funds can be used for those purposes. That includes costs for expenses in 2025, 2026, and for award closeout expenses. The estimate isn't the only way to spend funds on these costs. For example, a recipient could create an interagency agreement or contract for an eligible project that includes such expenses. And that would also mean that funds were considered obligated for those purposes. But the estimate is another available option to you. Now let's zoom back out to estimates in general. This slide summarizes the options available for estimates of both personnel costs and those administrative and legal costs. As I mentioned earlier, these estimates aren't mandatory. They're available if a recipient has not reported the relevant obligated funds in another manner, and that ensures that those funds remain available after the obligation deadline and are not returned to Treasury. These two kinds of estimates have different deadlines. For personnel costs, estimates are due by January 31, 2025 for quarterly reporters and April 30th, 2025 for annual reporters. For administrative and legal costs, estimates are due by July 31, 2024 for quarterly reporters and April 30th, 2025 for annual reporters. You'll note that this is an extension from the deadline in the obligation IFR. Treasury updated this reporting deadline to give recipients additional time. Below, this slide has a little bit of information about how these estimates work. You can refer to the FAQs listed for more information. And at the bottom, you'll also see the FAQ with more information on the estimate for costs related to contract change orders and contingencies in the event you're obligating funds for those purposes. We are going to discuss these reporting questions in greater depth in a future webinar, so I'm not going to go into further detail here, but I encourage you to take a look at these FAQs and stay tuned for more information. Let's sum up with a case study. A recipient plans to hire an independent auditor to conduct a single audit that will include SLFRF funds. The single audit will be conducted in 2025, and the recipient has not yet selected an independent auditor. Let's answer this question via poll. The question is, can the recipient use SLFRF funds to pay the independent auditor for the single audit? Choose the best answer. The choices for your responses are no. Single audit costs are not considered obligated without a contract with an auditor. B, no, the recipient must immediately return unexpected funds to Treasury after the obligation deadline. C, yes, single audit costs are considered obligated due to a requirement of federal law or regulation. Or D, no, recipients can only use unexpended funds for payroll expenses. Thank you for those of you who provided responses. I see that almost everyone has answered the poll, and 93% of you answered the correct answer, which is C. Yes, single audit costs are considered obligated due to a requirement of federal law or regulation. Let's move to the next slide. Now, let's talk about another clarification made by the FAQs, the treatment of interagency agreements. In FAQ 17.6, Treasury clarified that interagency agreements that meet certain conditions qualify as transactions requiring payment and are thus sufficient to meet the obligation requirement. If you finalize an interagency agreement by the obligation deadline at the end of 2024, you can treat that interagency agreement as the obligation of funds that a government agency will then expend in 2025 and 2026. Memoranda of agreement and memoranda of understanding can count as interagency agreements. Any agreement must meet the requirements that are summarized on this slide in the table and that are further detailed in FAQ 17.6. Let's look practically at how this might work, and we'll do so with another brief poll question. This should open up in just a moment, and you'll have 1 minute to respond. The question is, would creating an MOU between the County Commissioner's Office and the county's Department of Education for local community colleges to provide pre-apprenticeship training constitute an obligation? Choose the best answer. The choices for your responses are A, yes, if the MOU meets conditions in FAQ 17.6. B, no. C, yes, but only if the county's Department of Finance is also a party to the MOU, among other requirements. Or D, no. The county commissioner can only use those funds for payroll expenses, not an MOU. Take a minute to answer the poll. Thank you to those who provided responses. The correct answer is A, yes, if the MOU meets certain conditions in FAQ 17.6. It looks like 94% of you chose the correct answer. Great job. Next slide. I also want to note that existing MOUs can be used to obligate SLFRF funds. As this case study demonstrates, a recipient does not necessarily need to create a new interagency agreement. If a recipient already has an interagency agreement on the books that meets the requirements listed in our FAQs, that agreement establishes an obligation. A recipient can also modify an existing MOU before the obligation deadline to make sure it meets the necessary requirements. Please take a look at FAQ 17.6 for more information on these requirements. With that, I'll turn it over to my colleague, Eric.
Hello, everyone. I'm getting a little bit of feedback. All right. My name is Eric Roche, and I serve as a policy advisor for the SLFRF program. With the obligation deadline fast approaching, we know that many of you are working hard to get contracts and legal agreements in place for work that will occur after the obligation deadline is passed in 2025 and 2026. We also know that our recipients need flexibility to handle unforeseen situations that may arise in 2025 and 2026, such as a vendor going out of business or an unanticipated cost emerging on an underway project. First, let's discuss what flexibilities you have regarding contracts after the obligation deadline is passed. This is a long slide, bear with me. First, if your contract or subaward includes a mechanism for cost adjustments, such as a process for submitting and approving change orders or a contingency provision, then you may use SLFRF funds to pay for this cost adjustment. I'm aware that change orders may be called different things in different jurisdictions. When I talk about the circumstances that might create the need for a change order, I mean the typical cost that comes up as a project's being designed, built, delivered. For example, perhaps the type of equipment spec'd for the building turns out to be insufficient and a more expensive version is needed. Or if once construction is started, unforeseen site conditions are discovered that require additional funds to remedy. This is not an exhaustive list of these types of situations, but a recipient may want to use change orders to cover these sorts of costs. If your contract provides for change orders or contingencies that cover the situation, then those costs are considered obligated, and SLFRF funds may be used for them after the obligation deadline. Next, I want to address a frequent question we hear. The question is, will my jurisdiction be able to amend a contract after the obligation deadline has passed? The answer is yes. So long as the scope and purpose of the amended contract are substantially the same as they were in the original contract. In other words, you shouldn't modify a small contract for something like replacing a few sidewalks into something that installs a 4-lane highway. To be clear, Treasury is aware that some amended contracts may have a higher cost. So long as the amended contract has substantially the same scope and purpose, you may use SLFRF funds to pay for the increased cost of the amended contract after the obligation deadline has passed. Finally, as discussed in the preamble in the obligation IFR, there are situations where you may need to completely replace an existing contract. A contract or subaward can be replaced when the recipient terminates the contract or subaward because the business defaults, closes, or cannot perform work, or the recipient and contractor or subrecipient mutually agree to terminate the contract or subaward for convenience, or the recipient terminates the contract or subaward for convenience if it was not properly awarded. If you are using this option here, please know that there needs to be clear evidence that the contract or subaward was improper. And the original contract or subaward was entered into by the recipient in good faith. The recipient should document their determination that it was not properly awarded. I also want to mention the source of funds recipients may use to cover cost changes in contracts and subawards. Recipients may reclassify funds from another of their SLFRF projects as needed. For example, if you have a project that is finishing under budget, then you may reclassify the excess funding from that project that is under budget to another project, say one that is going over budget. Recipients will also have the opportunity to submit an estimated obligation to cover change orders or contract contingencies through the expenditure period. Recipients providing such an estimate will not be required to return such funds to Treasury after 2024, assuming that they are ultimately expended for an eligible purpose. Additional information on submitting these estimates will be provided in future webinars and reporting guidance. And also, of course, you can utilize non-SLFRF sources, such as your general fund, to pay for modifications to contracts or subawards. If you'd like to know more, FAQs 17.16 through 17.19 contain additional information. Here's another way to look at the different pathways available for modifying contracts. In the first row, we are looking at change orders or other price adjustment mechanisms that are typically included in contracts. Items like change orders can be funded with SLFRF funds after the obligation deadline, so long as the contract contains a mechanism for the cost adjustment, such as a provision allowing change orders. The second row details when a contract can be amended. Amending a contract allows recipients to keep the same contractor, but addresses unanticipated changes to cost. The replacement contract must be for substantially the same scope and purpose as the original contract. In the third row here, well, it details how a contract can be replaced. This is useful to recipients if they need to switch to a different contractor. The recipient must find itself in one of the three circumstances we talked about on the previous slide. And also, the replacement contract, just like with an amended contract, must have substantially the same scope and purpose as the original contract. Let's look at some quick examples. Here, a city is using $1 million in SLFRF funds to build affordable housing in 2025 and 2026. However, in 2025, it's discovered that the project needs to be updated via change order, and the total cost is now $1.5 million. So the question is, can the city use SLFRF funds to cover the cost of the change order? The answer is that change orders or other types of cost increases are allowed if they were contemplated in the original contract. In this case, the city's contract included standard change order processes and language, and thus they may use SLFRF funds for the increased cost. Before the obligation deadline arrives, you may want to review your contracts in several words to see if they speak to the possibility of cost modifications like change orders. FAQ 17.16 contains additional information. And I've got one additional example for everyone here. Let's say a recipient has awarded a contract for a capital expenditure, but then in March 2025, after the obligation deadline is passed, the contractor goes out of business unexpectedly, and the project's only 50% complete. The recipient would like to enter into a new contract with a different contractor to complete the project. The question is, can the recipient enter into a new contract after the obligation deadline with a new after the obligation deadline is passed so that they may complete the project? The answer is yes, so long as the new contract is within substantially the same scope and purpose as the original contract. And with that, I'm going to hand the presentations off to my colleagues Mira and James, who are going to walk through some Q&A.
Thanks, Eric. So the purpose of this Q&A session is to reiterate some of the points that we've discussed in today's webinar. We know that there are probably a lot of other questions you have, including some practical questions about how you report some of these obligations to Treasury. But as a reminder, we're not going to be covering those types of questions today. I will note that we do plan to provide additional resources in the future that gets more into the how-to of these types of questions. So Mira, if you're ready, let's start with a lightning round of some basic Q&A about today's webinar. So the first question that I've seen a lot, when can we expect to have the final rule on obligations?
Thank you, James. Treasury is not issuing a final rule. The FAQs are the most up-to-date source of explanatory information about the SLFRF obligation requirement and other program rules. And to the extent that the FAQs differ from previous explanations of the obligation requirement given, such as the obligation IFR and webinars, recipients and auditors should rely solely on the guidance in the FAQs.
Thanks, Mira. Another question I've seen a lot in the Q&A today, what if I have already obligated all of my funds?
Well, please ensure that you've read and are following Treasury's rules and guidance regarding what constitutes an obligation, including the new FAQs we're discussing in today's webinar. If you have obligated all of your funds in compliance with Treasury's rules and guidance, then you don't need to make any changes or take any additional steps to comply with the obligation deadline. Do remember that all recipients must continue to submit project and expenditure reports to Treasury, even if you've obligated and expended all of your funds.
Great. Another question I've seen today, do programs or projects under the revenue loss or government services eligible use category follow the same obligation requirements?
Yes, all SRFRF funds under any eligible use category are subject to the obligation requirements. You can see FAQ 17.15 for more. So this means that projects underway in the government services category must be obligated via one of the same pathways that were outlined in slide 8 of today's presentation.
Great. I am also seeing a lot of confusion about these references to estimates. So can you clarify for the attendees in today's presentation, estimates of what and when are they due?
Yes, we know that many recipients still have questions about what estimates are due when and for what types of obligations. Our hope is that today's webinar may have provided some additional basic clarity. The important thing to remember is that these estimates, should you want to submit them, are not due for another couple months if you're a quarterly reporter. If you only have to report to Treasury on an annual basis, then you have until April 30th, 2025 to report these expenses. For those who have quarterly reports with reports due January 31st, 2024, we plan to provide additional information and guidance on those estimates ahead of that July reporting deadline. Also remember that these are estimates. It's okay if they change, and you'll continue to update these estimates through the reports due January 31st, 2025.
Okay, thanks, Mira. Now, I have a few more detailed technical questions for you. So that, these are real questions submitted to Treasury by recipients. The first of which, one recipient asks, can we use SLFRF funds to cover payroll costs between January 1st, 2025 and December 31st, 2026 for direct program personnel and not just administrative personnel functions that were listed in the obligation interim final rule?
Yes. In the new FAQs discussed today, we explained that they provided further guidance on several ways that recipients may consider payroll costs to be obligated. FAQ 17.6 provides an example of similar transactions that require payment, which included interagency agreements meeting certain conditions. And payroll costs may be included in what's covered by such an interagency agreement. In FAQ 17.7, we describe when recipients may consider personnel costs to be obligated by the December 31st, 2024 deadline.
Great. So another recipient asks, so they say, we are a recipient that received less than $10 million and they only report annually in April. If the obligation deadline is December 31st, 2024, but their annual report isn't due until April 30th, 2025, when do they submit final obligations?
Great question. Recipients that are required to report annually will submit reports by April 30th, 2025 for activity through March 31st, 2025. These reports must reflect all obligations made by December 31st, 2024 in compliance with the deadline. If you're providing estimates of personnel, administrative, and legal costs to be expended in 2025 and 2026, these reports should also reflect those estimates. You aren't required to report an estimate of those expenses. But if you have funds that you would otherwise have to return to Treasury as unobligated, submitting an estimate will ensure that those funds are considered obligated, and therefore you won't need to return the funds. Recipients that are required to report quarterly will reflect obligations made by December 31st, 2024 in the report due January 31st, 2025. Quarterly recipients will be able to submit estimates of personnel, administrative, and legal costs in the reports due January 31st, 2024. They will continue to be able to update these estimates throughout the report due January 31st, 2025.
Great. So another recipient asks if we have filed a report in the last 2 years in which we used up all our funds, do we still need to file this year? So they were under the impression that they were finished with needing to report the funds.
Even if you've already spent all your funds, recipients are required to continue to submit reports to Treasury. This is outlined in SLFRF compliance and reporting guidance. In the future, Treasury will provide closeout instructions that will provide information to recipients on how to complete and provide final reports.
Perfect. And it looks like we have one more question, time for one more question today. So the last one that I have for you, Mira, is do all programs have to be estimated for funds that will be expended in 2025 through 2026, or is it only administrative funds?
So section 3 of today's presentation walked through the different kinds of estimates. This slide deck will be available on the SLFRF website as soon as possible, and the link to which is dropped in the chat. I encourage you to refer to that section of the deck to better understand what estimates are, the circumstances under which you might encounter submitting them, and the deadlines for submitting them. Thank you.
Okay, thanks, Mira. I am going to hand it off to SLFRF Program Director Vero Soto for some recap and a closing. Vero?
Hi, thank you once again for joining us here today. We have answered a lot of questions in the Q&A, and there's some we haven't gotten to. So I'm going to just do a quick recap about what we have discussed. Today's webinar was focused on explaining the new FAQs that Treasury released to provide additional clarification and guidance on how to meet the obligation deadline for SLFRF funds of December 31, 2024. Again, the FAQs can be found in section 17 of the SLFRF FAQs. And again, those have been hyperlinked in the presentation, and I know the link has been dropped in the chat. So I saw a lot of questions about how to do some of the things that are outlined in the FAQs. And just a note, we will be providing additional information and resources in the future to explain some of the practical how to report on these new pathways. So there's more to come. You had a lot of detailed questions that need to be part of those resources on how to report for these new pathways. So if you have questions in the meanwhile, you can contact us. We have our email at slfrf@treasury.gov. You see it on the slide presentation now. And so please continue to send your questions. April is pretty busy, so we're getting through the questions that we got. Gosh, guys sent over 500 questions per day on April 29th and April 30th. So we're still going through those questions that came in last week. So please continue to send questions to slfrf@treasury.gov. Thank you once again for joining us here today. Hope you have a good rest of your day. Thank you.